In April, a man named Marcus checked his portfolio and saw red across every line. War headlines, oil prices spiking. His hands were shaking when he sold everything. 3 months later, the same portfolio, if he'd left it alone, would be worth 14% more. He didn't lose money because the market crashed. He lost money because he panicked at the exact moment it was about to recover. Here's the question that should terrify every investor watching this. How do you know, in the middle of a crisis, whether you're looking at the start of a collapse or the bottom of a rally? Most people think they'll know it when they see it. They won't. And by the end of this video, you'll understand exactly why your brain is wired to get this decision wrong at the worst possible moment. Let's set the scene. This past quarter, global tensions escalated fast. A war between two nations disrupted oil shipping routes. News anchors used words like crisis and escalation on repeat. Stock futures dropped. Retail investors, people like Marcus, watched their apps turn red and felt their stomach drop with it. This is not a hypothetical. This happened, and it triggered exactly what happens every single time markets get scary: a wave of panic selling. But here's what the headlines didn't emphasize enough. While individual investors were pulling money out, institutional algorithms were doing something different. They were buying. Not because they're braver, because they're not making the decision with their amygdala. They're making it with a spreadsheet. By the end of the quarter, despite the war, despite the headlines, despite every reason to be afraid, the market posted one of its strongest quarters in 6 years. Tech stocks led a sharp rebound. Major indexes closed near record highs. The people who sold in March were not protected from a crash. They were protected from gains they desperately needed. But here's what makes this worse than just bad timing. What happened to Marcus has a name in behavioral finance, and once you understand the mechanism, you'll start noticing it in your own decisions. It's called recency bias, and it works like this. Your brain doesn't weigh all information equally. It overweights what just happened. If the market dropped yesterday, your brain assumes it will keep dropping. This isn't a character flaw. It's a survival mechanism that worked great when the market was deciding whether a rustling bush meant a predator. It works terribly when the market has priced in fear faster than you can refresh your portfolio app. Here's the part that should genuinely unsettle you. Researchers who study trading behavior have found a consistent pattern. The investors who check their portfolios most frequently during volatility are the ones who make the most reactive, most costly decisions. Marcus didn't check his portfolio once that week. He checked it 11 times. By the third check, he wasn't evaluating data anymore. He was managing a feeling. And this is where it gets uncomfortable, because I want you to think about the last time you made a financial decision. Not because of a plan, but because of a feeling that had been building for days. That's not a confession you make to me. That's one you make to yourself. Now, knowing this bias exists doesn't automatically protect you from it. In fact, the next part is where most people make a second, quieter mistake, one that happens after the panic, not during it. Let's go back to Marcus, because his story doesn't end with the sale. It actually gets more interesting here. 2 weeks after selling everything, Marcus watched the market start climbing back. His first instinct wasn't relief. It was a new kind of anxiety, the fear of having made the wrong call twice. So he waited. He told himself he'd get back in once things settled. Things never fully settled, because markets never do. By the time Marcus finally bought back in, the market had already recovered most of its losses. He'd locked in his loss on the way down and paid a premium on the way back up. The total cost of his 11 portfolio checks and his 2 emotional decisions, He estimates it cost him close to 4 months of his portfolio's growth. Gone. Not to the market, but to his own timing. Here's the detail that stuck with me most about Marcus's story. He told a colleague at work, almost as a joke, that he wished his portfolio app had a feature that locked him out for 72 hours every time he tried to log in during a red week. He was only half joking. He understood the mechanism perfectly. He still couldn't stop himself from acting on it. That's the real lesson here. Knowledge alone doesn't override instinct. You need friction, not just awareness.
Compare that to what large institutional funds actually do. They don't have less fear. They have rules that don't ask them how they feel before executing. Rebalancing happens on a calendar, not on a headline. That's not a personality trait you're missing. It's a system you can build.
So let's close the loop. The question was, how do you know if you're watching a collapse or a recovery? The honest answer is, in the moment, you usually can't. Nobody rang a bell at the bottom of this quarter's dip to confirm it was safe to stay in. The recovery only became obvious after it was already underway, which is exactly when it's no longer useful to know.
What you can control isn't predicting the bottom. It's building enough friction between your fear and your trading app that recency bias doesn't get to make million-dollar decisions on a Tuesday afternoon. A rule, a delay, a reason to ask, is this me or is this the news cycle talking? I'll be honest about something before we end this. I don't know if this rally holds. Tensions in the region that triggered this whole scare haven't fully resolved, and quarters that start strong don't always finish strong. Anyone telling you they know what happens next quarter is selling you confidence they don't actually have. What I do know is that the investors who built a rule for moments like this slept better in April than the ones checking their portfolio 11 times a week. If this video helped you spot that pattern in your own behavior, that's exactly the kind of thing worth subscribing for. And if you've caught yourself doing what Marcus did, I'd genuinely like to know in the comments, because you're not the only one.